Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Today's guest is Julian Brigden. Julian is the head of research at Macro Intelligence 2 Partners, a firm he co-founded in 2011. Julian and his team focus on independent macroeconomic and market research that consistently seeks to anticipate consensus views, I suppose, before they become consensus, and deliver timely insights. With the current global landscape and everything that's going on, I feel like it's an ideal time to hear Julian's perspectives. Welcome, Julian. Thanks for joining us.
Thank you, Alex.
Let me ask you a quick background question before we dive into all the really interesting things going on in the world. What would you say originally attracted you to become a global macro strategist?
Opportunity, a check. So I was in trading and sales for many, many years, working at various banks across the street. You did well if you changed jobs once in a while. So I was at quite a few, and sort of worked my way up the totem pole, and then stepped out for a while and worked in the sort of research space because I enjoyed that and I wanted to change the pace, and then went back and into the sort of sales side, working for a bank. And I was always in sort of fixed income and FX, so bond market and currencies. And then to sort of entice my clients to trade with me, I started writing my own thoughts on the market and got a pretty big following, Alex. And, you know, going into the financial crisis, made some of my clients a lot of money. And then one of them wrote me a big check and said, go and set up your own business. So I did.
So that was almost 15 years ago. How's it been going so far?
It's going very well. I do think there are times when I could have picked an easier job than trying to wake up every single morning and be one step ahead of the whole of the global financial market. But it's what gets me up every single morning and what motivates me. So I guess, you know, you pays your money and you takes your choice. And, you know, in that sense, you know, maybe I could be something else.
Obviously, there's a lot going on, but before we dive in, it may be helpful to set the stage. Would you describe how global economies typically function?
If you take a sort of 30,000 foot view of the world, we've tended to operate really since the beginning of sort of, you know, money in what is referred to as pax systems. So there's sort of a period where you have a dominant power, be that, you know, Rome or be that Britain or now the US, where you sort of get this relationship that exists between the sort of dominant power imposing its monetary system, the currency, its legal system, you know, rule of law, its stability, whether, you know, onerously in the case of the Roman Empire, or more benevolently in the case of the US Empire. But it sets up this sort of period of generally speaking, Alex, long periods of stability, long periods of globalization in terms of trade, and benefits for all, mostly to the reserve provider. Most of the benefits flow up to the top of that kind of pyramid. And we've obviously been in a sort of post-war period. We've been post-Second World War period, in a period where, you know, it's been Pax Americana. And I think the problem with these systems is not, we've had 7, right, throughout kind of history, and not one has survived the test of time for numerous different sort of reasons. But, you know, typically they tend to boil down to this sort of concept of imperial overreach that kind of in the imposition of enforcing this system. You know, often, as I said, onerously, if you say the Roman Empire, you kind of stretch yourself too far. You don't have enough troops. You can't fund the troops. You know, the Visigoths and the Huns end up attacking you and then, you know, turn up on the outskirts of Rome and sack Rome, right? And the whole system sort of collapses. There often it comes with financial strains. It often comes with technological changes which challenge your technological dominance. And so they just haven't survived the test of time. And there's also, you know, this military tone that exists with it, this element which exists to it, which, as I said, either is forcefully imposing the rules or benevolently imposing the rules. But it's a very important that role, particularly, let's say, in the current system, the US has provided a military shield security to its allies. And in return, they've been willing to work in a US-dominated system, which is what the US set up after the Second World War. And all those benefits have derived from that. And in terms of financial flow, it's basically boiled down to the point that foreigners are prepared to fund our spending, our excessive spending, in return for us providing that protection. And in that sense, we've hit this tipping point, I think. I mean, I don't want to get overly complicated, but in economic terms, it's referred to as kind of Triffin's dilemma when you are the reserve currency, that essentially the costs to the reserve provider, in this case the US, of providing that currency and keeping it stable and keeping it strong begin to outweigh the perceived benefits. I will say perceived benefits because I'm not sure that we're going to be right, that the costs are higher than the potential benefits we can gain. And so this leads to a reassessment within the reserve provider. And that's certainly, I think, what the Trump administration is manifesting in terms of their policy. So I think we are in danger. I think, firstly, we're definitively changing the rules. I think that is going to have very significant consequences. And I think also we are potentially changing the rules and changing our approach to such a degree that it potentially threatens, at an embryonic stage, Pax Americana. Look, I will say this, Alex. For most of any trending market, macro is marginally important, but it isn't the driver. Macro really comes into its importance at inflection points. And I think we are at a possibly a sort of 80-year inflection point, so like a post-Second World War inflection point, but at a bare minimum, a sort of 40-year inflection point, 30, 40-year inflection point. And so I don't think macro has been any, more significant than it is now.
Okay, so we're gonna get into all of that. But I just wanted to lay the foundation. So we're going to talk about some terms that maybe not all the listeners are familiar with. So I think most people know what a fiscal deficit is, when you spend more than you earn. But would you briefly explain what a trade surplus or deficit is and a current account surplus and deficit?
So this is literally a function of the trade and services that flow in and out of a country. Think of it as a ledger, right? What we export goes on one side, what we import comes on the other. That's the trade deficit. Then you have the components of that. So there's a current account deficit and the capital account deficit, and those have to balance. So if we spend more than or if we import more than we export, Alex, right? Somehow that has to be paid for. It has to be paid for by foreigners, right? We cannot, if we're importing from, let's make a simple environment. Let's say there's only China and the US in the world, right? So we export, $1 worth of product to China, but we import $2 worth, okay? How do we fund that extra dollar? Because it comes in renminbi, right? We're buying for something in renminbi, in the Chinese currency. And the way that we typically do it is that we either borrow from the Chinese, that dollar, or the Chinese buy something else in the US or invest it. And so typically what they do, and the way that certainly we've been doing it most recently in the US, is they buy US assets, right? In the sense of they either buy, tangible assets like land or factories, that sort of thing, or buildings, or they buy treasuries or equities. So that's how you have to balance that equation. You can't run a trade deficit or current account deficit without that offsetting flow because you can't fund it. So that's where we find ourselves. We've been running a significant and ever increasing current account deficit. On an annualized basis, it's running roughly at $1.2 trillion. That's about 4% of GDP. Now, that may not sound too onerous, but if any of your listeners are familiar with emerging markets, if you go back and you look at history of Brazil, for example, whenever their current account deficit hit 4% of GDP, their currency got eviscerated. I mean, Alex, eviscerated, like 75% loss of value. So we are basically living beyond our means. We are not putting that money into particularly productive things. I like to use the analogy, we're sending a bunch of US influencers to, Santorini so they can stand on a cliff and take a picture for the other influencers and ruin it for everyone else. And in return, we are selling the family jewels to do that. So we're selling the foreigners Nvidia stock. Don't know whether I call the treasury quite the family jewel. Not a very good view of treasuries as an investment. But that's essentially what we've been doing.
So the headline is about the massive fiscal deficit. The government is spending so much more than it's earning. And as a result, we have this growing debt burden, which is clearly unsustainable long term, although it's been going on for a long time. So what causes that tipping point?
I believe that there's an ongoing, somewhat mechanical cycle. Not to get too technical, but George Soros, who some of your listeners may have, or viewers may have heard of, very, very famous macro hedge fund investor, he came up with this term called reflexivity. And he came up with this term to explain to economists why markets are not always in equilibrium. So the assumption, if any of you have ever studied economics, is, markets are always in equilibrium. That's a given. Well, they're not. And Soros came up with an explanation where he said, if in the process of purchasing an asset, a stock, let's say, by purchasing the stock, it actually improves the fundamentals that drive the valuation of that stock, you can create this kind of virtuous circle. You buy more and more stock, the fundamentals get better and better through that process. You can create this virtuous cycle. But he called it reflexive because it depends on continuing purchases of the stock. And if at some point this thing reverses, then things can kind of go wrong. So I think this cycle really depends. I think it is reflexive. I think, as I said, it's depending on purchasing. I think it's somewhat mechanical. So I think it really depends on three key metrics, Alex. The first metrics is that foreigners have funded us in their own currency, right? They have sold their currency and bought US dollars. They have an FX exposure, currency exposure to the US. So if the dollar were to fall in value significantly, the value of the assets that they own in the US to fund our spending drops, okay, in their currency. So if one day the euro value, let's say, or the yen value of the S&P deteriorated materially, the risk is that they sell those assets and they take the money home, okay? So the dollar is very important. Secondly, the US has to outperform in terms of asset performance. So if one day we wake up and we say, I don't really want to own Nvidia, I want to own European defense stocks, or I want to own Brazilian mining stocks, then the money goes home. And as the money comes home, it gets sucked out of US assets, and US assets start to underperform, and you start to change the cycle around the other way. And thirdly, and this is where the mechanics come in, the US economy needs to continue to run a large current account and budget deficit, because if one day we solve those, if the Trump administration gets what it wants and we don't have a trade deficit, then foreigners, there's no need for us to suck that money in. So foreigners will sell their US assets and take that money home. So it's not difficult to envisage a situation, Alex, given the policies of this administration, which I'm not saying are wrong. I think in many respects, they're absolutely right. I've just said to my clients, it just has consequences beyond the ultimate aim, right? That if you started to see the Trump administration drive a weaker dollar, if we went into a recession as a result maybe of Doge, right? Or if through the imposition of tariff restrictions or whatever you want to call it on, chip exports, which we just got announced again last night, that, Nvidia stock drops or US semi stocks drop or whatever, right? That we ended up with the US equity market correcting. This virtuous circle, which I think has been running certainly since 2014, but arguably since 2011, which has built up an inordinate, Alex, amount of inflows into the US, could turn from virtuous to vicious. And because it's reflexive, it will become self-reinforcing.
So basically, you have this self-feeding cycle that starts and it keeps going until something breaks the cycle, causes it to reverse, and then it accelerates in the other direction.
Yeah, and look, I mean, we've seen these cycles before. We've seen people, they're not always, I mean, I don't want people to go away and like slit their wrists. I mean, we've seen, I will warn people that typically in the inflection point in the cycle is what I would call nasty, right? So US stocks typically correct down and they take everything down. It's just they correct the most because that's where the money is, right? Eventually, though, we get to a point where typically the Fed is eased enough, the dollar is starting to weaken, which in itself is a reflationary thing. It's just in that phase, Alex, which, for example, we saw, as I'm sure, as a RIA, you're very aware of, from 2002 to 2008, right? That was not a bad time to be in the US. It's not like we were all standing around in soup lines. It was still quite a profitable time to be around. We were making money. Everyone was generally happy. It was just a crappy time to be in US in assets, right? They underperformed the rest of the world. There were far better things to be invested in. And it certainly was a bad time to be in the assets that we're all heavily invested in. So tech, consumer discretionary, healthcare, financials. Those are absolutely the worst performing assets to be in. So, but there were plenty of ways to make money. It's just we aren't in those trades at the moment.
So could AI save us? Meaning that the productivity enhancements can help us grow our way out of our debt problems and offset some of these macroeconomic risks?
There's definitely ways to do this. I mean, if we get AI, we can run and if it really starts to kick in materially, I still think it's a little further out in terms of the impact on productivity. I keep hearing people say, "Oh, productivity is rising." Well, it isn't in official stats; it's continuing to fall. Right? It's very moribund if you look at the official stats. Productivity would enable us to run higher nominal GDP. So, but with hopefully stronger underlying real growth. So that would help us definitely grow out of the debt crisis, but in the nice way. I mean, because there's two ways that you can do it. We can inflate our way out of it. So we just run very high nominal GDP, but because the trick is, as long as your nominal GDP is above the cost of your debt never becomes a big problem, okay? On paper, in an enclosed world, all those sorts of things that economists will throw in there, as an offset and condition. But that's the way you can do it. But you can do it obviously with more rapid real growth, which is what we want, or you can just do it by running very, very high inflation. So productivity would enable you to run higher real growth, and that would in itself be positive. I don't think, though, that it necessarily saves the US. I mean, I think we have to go through a period where we actually start to focus on the debt. And I think that the Trump administration has logically decided to address the deficits, right? I think we were truly on a path of utter unsustainability where we would have inevitably hit a tipping point where I think the trust in US assets as a store of wealth would have been questioned. And, some of your viewers may have been familiar with what happened in the UK with the so-called Liz Truss moment, where the Bank of England had to intervene basically to stabilize the UK bond market because the government was spending too much money. And I think the US is flying dangerously close to those sorts of levels. And so I think the Trump administration is right to focus on that. I certainly know the Treasury Secretary is very focused on that. What I would say is that that doesn't have consequences. When you have a government that is spending 6.5% of GDP year in, year out, adding to GDP, if you were to eliminate that tomorrow, we'd have a worse recession than the global financial crisis, right? So we have become highly, highly addicted to debt and overspending. And so I think we need to go through this purge. We need to go through this clear out period. I think it's absolutely necessary. I'm glad someone seems to be taking it seriously. I say seems because they're still spending a lot of money, but it's going to have consequences, ladies and gentlemen, and it's going to be a painful adjustment process.
Would you tell us about the Mar-a-Lago Accord and its feasibility, and also how it compares historically to prior accords like Plaza and Bretton Woods?
Yeah. So one of the rumored proposals of the Trump administration, I say rumored because it was written, the Mar-a-Lago Accord is part of a paper written by this gentleman called Stephen Mirren. And Stephen wrote it back in November of last year, and he was just a smart research guy at a hedge fund called Hudson Bay Capital. So subsequently, he's ended up working for the Trump administration as the head of National Economic Advisors Board, which is the board that advises the administration on economics. And we're starting to see senses, Alex, fingerprints out there that kind of suggest that this is something that is being ruminated. Now, what Stephen wrote, and you can find it out there, is a very, very in-depth, clever piece of research that looks about how to go about resetting global trade relationships so that we try and get rid of this 4% of GDP trade deficit that the US is running and put things on a more sustainable path. And there are a number of elements, okay? One of them, and at its core, really what they're kind of trying to do is lower the value of the dollar. Now, I want to stress, I'm not talking about the dollar losing its reserve status, quite the opposite. They want to actually strengthen the fundamentals behind the dollar to ensure that it remains the reserve currency. It just means they want a lower value versus other currencies for now. And certainly, I think there are some other proposals in there about forcing allies to assume some of the burden of the cost of their own defense via accepting lower or no yields on their treasury holdings, et cetera, et cetera. But, there's lots of sort of detail. But essentially, at its core, this is something to try and reset trade, get a weaker dollar. And in that sense, certainly that element is actually not unusual, right? If you look at, we've only had freely floating exchange rates since the very early 1970s. And in actual fact, we've had, this would be, if this were to happen, the third time that a Republican president has employed this tactic of kind of forcing a currency deal on the rest of the world. The first one was when we entered into the era of freely floating exchange rates. The US we'd had a fixed exchange rate mechanism that was called Bretton Woods that existed since the Second World War. We got to the late 1970s, it wasn't working. The US was spending too much money. It was putting internal stresses on the system. And back then it was related to Vietnam and various other, guns and butter, the Johnson administration. And kind of a similar thing. We were living beyond our means. We needed kind of a weaker dollar to reset things. And Nixon imposed some tariffs, it's referred to as the Nixon shock, on the Japanese and the Germans to force them to the table to accept a weaker dollar as part of the unwind of Bretton Woods. Then in the mid-'80s, I think the Republican president that many of older Republicans would hold out as the paragon of virtue, Ronald Reagan, did kind of the same thing just ahead of the Plaza Accord, where we saw another big correction in the dollar. And so in that sense, what is being proposed is not at face value that unusual. It's actually standard kind of operating procedure for a Republican president it just has consequences, Alex. And from an investor perspective, that's what you've got to be aware of and position your portfolio accordingly.
Do you sense that the world is gradually dividing into two distinct blocks, forcing countries to choose sides, both economically and geopolitically?
I think that's been going on for a while. I mean, we started to write in 2018 that we were reaching the peak of what had been dubbed chimerica. So this sort of symbiotic relationship between China and the US. And we said, no, it's all over. It's pretty much peaked and it's going to deteriorate from here on out. And while people now accept that as a given, it certainly was not the case back in 2018, where everyone, if you remember, was rushing to buy Chinese stocks and to open up, relationships with the Chinese and export Cadillacs and, God knows what else to the Chinese. And that was the beginning of this division. I think that itself is a manifestation of a rise of populism, as I said, and this sort of concept of Triffin's dilemma, that it was no longer working for Americans, this sort of let's call it hyper-globalization, where, as a result, and really, here's the thing that I don't think a lot of market participants realize. I think a lot of people look at what has gone on in the States and in most developed industrial countries since, call it the late 80s. And they look at the demise of manufacturing and the growth of Chinese or Asian or Eastern European or Mexican manufacturing, and they say, aha, those guys are the bad guys. Well, certainly they're the beneficiaries, but who made the decision? The decision to outsource US, European, UK manufacturing was made by the C-suite. And the decision was made to improve shareholder value, aka management's personal returns, because they're paid in equity. And these, in a way, are the villains. This is why when someone like Scott Bessent says, the Treasury Secretary, we think Wall Street's done pretty well, right? It's time for Main Street to do better, because those are the decisions that have divided us. But that, I think, is leading to this next stage of this decision. And we've reached this tipping point, which is, can America continue to spend and provide the military defense that goes with, and, contain China and stop China, but still contain Russia and do all these things? And I think the answer looks increasingly to be no. Essentially, we've reached this point where we've reached imperial overreach, right? We can no longer stick our fingers in every single hole in the die, right? We're going to have to rely on others to do that. And that is fine. It just comes with material consequences. And I think when I look at the world, I hate to say it, I think we, and I've got many friends who are involved in this space. When you look around the world, if we become increasingly isolationist, it will create a more unsafe world. It will create a less wealthy world. I'm not sure it will necessarily benefit us, because remember, we're going to be leaving large tracts of the world with the vast majority of the population to be dominated by China and not dominated by us. Maybe there's 1 billion people, if you're lucky, in the developed world, right? So is that going to be our marketplace? Well, good luck if you're Apple or Tesla, getting, or even Google getting compound results in that kind of world.
So you touched on this earlier. You talked about a potential inflection point going back 40 years. And I think that's an interesting time period, because most investors, if they've been around a long time, that's their frame of reference. And so do you feel that there are some long-standing market relationships that may be very different in the next decade or longer, that somebody who's been investing for 40 years or within that time frame may feel like there's a relationship?
I think if you've been investing for 40 years, you've seen these before, right? But, I'm pretty old and I haven't been investing quite for 40 years. And, there are days when I certainly wake up and feel like I've been investing for 100 years. every single day, but I was certainly around and corpus mentis enough to sort of understand. I mean, I already started in like 87. But in the 40-year thing, I'm talking the last time we saw a currency accord, right? And I do think the dollar is, and I do want to stress to you, as a retail investor, you getting the trend in the dollar right, as certainly as a US investor, will determine all your gains, right? If you get the dollar wrong, you will be invested in the wrong sectors, you will be invested in the wrong countries, and you will be invested in the wrong assets, okay? Now, in terms of trends, I would say that certainly to assume that we continue the trends of the last, as I said, I think these trends really started in 2014, but arguably in 2011. So if you think that we continue along the path of the post, let's say, global financial world, where US assets continue to just inexorably outperform, where we continue to suck in ever greater percentage of global savings. I mean, at the moment, the US demands, just to keep the relative performance where it is in the equity space, so US against the rest of the world, demands that it takes 70 cents of every $1 that goes into global equities, right? 70 cents. So what's that going to grow to? 80? 90, 100, right? So no one's going to buy any assets, abroad. There's going to be nothing worth investing in anywhere else. I mean, the mathematics just doesn't work like that, right? So I think, as I said, I think this relationship depends on an ongoing strong dollar, which the Trump administration doesn't want, ongoing US asset outperformance, which I think is questionable. I think we're breaking some relationships that have been in place over this decade, 15-year period, and a strong, robust economy, which cannot slow down, which cannot go into a recession. And I think all of those three are in question, Alex. And I think the consequences in terms of your asset allocation mix are inordinate.
One of the relationships that has become a standard expectation is the stock market, at least in the US, goes down in anticipation of a recession. However, if we just look backwards, it's a strong equity market that has fueled growth and the wealth effect and has created a stronger economy. So could it be the opposite looking forward, where you need a stock market decline that causes a recession?
If you cast your mind back to sort of pre-election, August, September of last year, we're actually beginning to see some quite material weakness in the labor market. We've seen a slight uptick in unemployment, but some of the underlying metrics were deteriorating even more rapidly. You could see that this was a market where businesses were getting increasingly unsure ahead of the election and because of the Fed rate policy, and were slowing down hiring. Now, the good news, Alex, back then is we never got mass layoffs, right? But we were missing something else as well, which one of my clients pointed out to me. Historically, when you've gone into recession, you've seen two things. Firstly, you've seen a slowing of the labor market metrics, right? Labor starts to slow down, consumer confidence starts to wane a little bit, right? You start to question the consumer. But the coup de grace, the death blow, is provided with that equity correction. And in Q3 last year, we avoided that. This time, we've arguably already had one, being down 10%. I mean, is that enough? We'll see, right? And the reason that that's important is very simply that if you look at it on a statistical basis, equities lead employment by 6 months, equities lead CapEx, equities lead sentiment, both business and CEO. And it's very simple. I have just a very simple metric. When stocks are rising, CEOs hire. When stocks are falling, CEOs fire. Because CEOs are only paid in this very screwed up world that we live in, Alex, to do one thing and one thing only, and that is to be shepherds of an equity price, right? We don't even want necessarily, a few years ago, we didn't even want them to make profit, right? We just wanted them to be cheerleaders who just drove up the stock price through, creating revenue. And that's the result. You end up with a world that is hyper sensitive to the equity market. And then in addition, here in the US, wealth has been such a driver of consumption. The top 10% is now responsible for, according to Moody's, 48% of total consumption. They're responsible for, I think it's 52% of total consumption growth in the last 4 years, right? That if you were to get a drop in stocks that is lasting 20%, then your consumption just doesn't slow, it implodes.
You talked about markets often being reflexive, and particularly with trends reinforcing themselves. And we see this when assets go up, investors go in, and when asset prices go down, they sell. And so you've had this reinforcing cycle of strong dollar, strong US asset performance, money from outside coming in.
Yeah, look, tell me now, you're an RAA, right? You've got lots of very wealthy people who are sitting on inordinate portfolio gains, who are all feeling pretty chipper about the world and are probably approaching you for loans, or were up until recently, for loans against their portfolios to go and buy a new house or go and buy a new boat or go and buy a new aircraft, right?
Yeah, I mean, our clients are pretty conservative. So, but I hear what you're saying. Yes.
I know that, I know this is, I've got friends who are in this space who maybe are not as so conservative as you guys, and these portfolio loans were the way that you raised cash, right? Because it was super cheap up until a couple of years ago, right? And they did.
Right. And then you can see a reversal occur, whatever causes it, and it can go the other way. And I think many people, because those cycles last a long time, forget what it was like before that cycle started.
Correct. And I think, look, do you honestly believe when you look at yourself in the mirror that we've discovered economic and financial perpetual motion? Right? That history no longer applies, that cycles no longer apply, that suddenly we're just, we have discovered nirvana. I don't, right? I look at the mechanics and I look at the setup and I think, as I said, it's dependent on an ongoing strong dollar, which we don't seem to want, an ongoing strong economy, which is increasingly questionable, and asset outperformance in the US, particularly in the equity market, which I also think is increasingly questionable. I think, one of the topics we haven't covered, Alex, is one of my big fears is we paid simply too much for a lot of assets. And I think that it is never about the story, right? The better the story behind the asset, historically, the bigger the bubble, right? The only one that I can't figure out is the tulip bubble, right? In Holland. Generally, most financial bubbles are created with an incredibly strong story, right? The dot-com bubble was an incredibly powerful story. It's what is enabling us to have this conversation today, right? We are building, on those sort of 25-year-old technological breakthrough. And I think AI and all those things are important. They will be transformative. You must really, really be careful about being suckered in by the narrative, because the only thing that matters is what you paid for the asset, right? That's the only thing that counts. And when I look at what we are paying for assets, I'm afraid I think we're paying too much. I think the first, particularly against what China is doing. So I think deep sea was an epiphany moment. And we suddenly found out whether, I know, some people claim, well, they were just using NVIDIA chips or they were doing whatever. It doesn't really matter. They're doing it for a tenth of the cost. There's another one that's just come out that was announced. I think it was ByteDance. I think it's called Ernie or something. It began with an E the other day, and they're doing it for 100th of the cost, right? An AI product. We had a piece in the Wall Street Journal a couple of months ago that was talking about how large pharma is now no longer looking to unicorns in the US to buy, which cost them a couple of billion dollars. They're looking to Chinese startups that cost them a couple of $100 million to buy. We have BYD coming out with a car which includes their version of FSD. I'm sure some people will say that, it's not as good as Tesla. It doesn't really matter. By the way, Tesla had to remove the term FSD. They did it last night on their software in China because the Chinese authorities do not consider it to be full self-driving, right? But what BYD were charging for the car plus the technology is pretty much what Tesla is trying to charge for the software, right? So once again, it is arguable we've simply paid too much for our assets. And so I look at this setup, as I said, strong dollar, strong US economy, overvalued equity market or overvalued asset market. And I think the mechanics are there, Alex, to start this slow unwind, throw in question marks over the reliability of the Trump administration to be a reliable, trustworthy defense provider. And you have the beginning of potentially a weak dollar cycle, which will utterly upend, I would say, I don't know how you positioned your investors' portfolios, but I would say 99% of high net worth individuals' portfolios over the next decade.
Yeah, and if you look backwards the last 10, 15 years, US stocks have done great, and just about everything else has done poorly. Bonds, non-US stocks, commodities, just about everything else. So do you envision a world where you almost have the opposite outcome?
Totally. I mean, I think, look, maybe US stocks can do okay, but they will typically underperform. They underperform in a weak dollar environment. That may seem counterintuitive because you're saying, wait a second, I hear these guys on CNBC saying, well, when the dollar falls, it helps overseas earnings to some degree. But it's not about earnings, don't dictate the price of the stock price. What really determines it is flows into those stocks. And when the dollar is falling, foreigners are not going to be putting money into US stocks. They're going to be pulling money out of US stocks. And so I really do think that if we are at this inflection point, which it certainly feels like we are, then the next decade, if you stay invested in the stuff that you're invested in now, 99% of people are, you're going to do really poorly. I mean, you're certainly, at bare minimum, you're going to underperform. Worst case, you could lose a lot of money.
And I think what's interesting about that is because investors tend to chase returns, as US assets have outperformed, they've become more concentrated in US assets relative to where they were 10 years ago.
Yeah, I mean, you tell me. I mean, RIA friends of mine have said that sort of the balance you should sort of have is like 65-35 domestic overseas. But when I ask people what are they, they're like, well, 95-5, 99-1,
Yeah, that's part of the issue. I mean, one of the concepts that I've stressed for a long time is be diversified. And what does it really mean to be diversified? And it's been a painful conversation for, the last 5 years in particular, because you've been better off being less diversified. But it does feel like that may be changing.
I think it is. I mean, we combine sort of fundamental analysis with econometric models and leading indicators that we look across the market with technical indicators. And when I look at technical indicators, we are breaking trends in relative performance of stocks which have been in place for 18 years in favor of the US.
Yeah, that's a big deal. Earlier, you talked about you got to get the US dollar trade right. You've talked about a significant downside risk. Would you elaborate on that in terms of the dollar?
So, yeah, I can put some numbers on it. I mean, we have long-term models which we use to put a valuation on kind of the dollar. And if we just stick with something simple like the euro, right? So the euro is, we're hovering just around, under one sort of 10. We've moved up, we've hit one almost. We typically make the highs and low of the year in FX in the first quarter of the year. It looks like that spike down to sort of towards par was kind of the low. We're actually structurally pretty bullish, the euro. I think obviously, we've seen these defense spending changes in Europe. We think they will usher in a lot more fiscal spending. And when we look at the underlying fundamentals for the euro, as I said, we've got some long-term models. They put the value of the euro around 145 to 150. Okay, so we are talking 30% higher. That may sound ridiculous, but what's interesting is when that divergence occurred from the longer term models, Alex, and it all occurred around 2020, which is when our current account deficit blew out from 400 billion to 1.2 trillion a year. And essentially, what that should have done is that should have weakened the dollar, and the euro should have strengthened back then. But what appears to have happened is that Europeans took the money that they were earning from selling us BMWs or whatever, right? Parmesan cheese, and then recycled it back into US assets. So they basically, sold us Parmesan cheese, took the money, bought NVIDIA. And that's kind of where we are. And so we've left with this big gulf, right, between where we are at 110, where we should be, let's say 150. And I think if we destabilize those three metrics, the dollar, the strong economy, and the relative performance of US assets, if those start to shift, there is a risk that the dollar will rapidly, or the euro in this case, will rapidly rise and the dollar will weaken towards that 150 mark. And in that situation, European stocks are going to massively outperform for US investors. Gold and silver are going to massively outperform. Mining and metal is going to absolutely outperform. Tech, healthcare, consumer discretionary financials in dollars in the US is going to massively underperform.
So we talked about how most investors are not that well diversified. They're very concentrated in the things that have done the best over the last 10, 15 plus years. So what advice do you have in general for investors considering that, considering your views about where the world may be headed? What action should they take?
Look, they should go and talk to you. Sounds like you've got your head sort of screwed on and you know what you do. But I would look. I mean, I think you need to look. If you don't feel comfortable with sticking money abroad, you don't need to stick money abroad necessarily. You can make solid returns by taking some profits in your, tech stock, by taking your profits in your consumer discretionary, and you can buy energy, mining and metals, gold and silver miners, precious metals, and generally you do pretty well, right? Generally you'll do pretty well. I think you should have some non-US developed market equity exposure. I think you should have some emerging market exposure. And, outside the equity space, I think when it comes to treasuries, look, I don't want to take duration risk. I don't want to buy very long dated treasuries. They've been an absolutely atrocious investment, right? Relative to, say, gold, right? Relative to gold. They've underperformed, including the coupon that you've earned for 25 years, right? These are an instrument of confiscation. The US government needs you to lose long-term value in those. Otherwise, they will not pay down the debt, right? So you need to avoid, I think, very long-term exposure to the treasury market. Look, if we get a deep recession, I think we could get 10-year treasury yields moving down to 3%. So you get a trade, right? But at that point, I would run away. There's a very good bond investor called Jeffrey Gunlake, and very, very good bond investor. And I tend to agree with him when he says, when I look out at, say, 30-year yields, I'm not even sure, even in a recession, that those things are going to fall that far because of what a recession typically does to the deficit. So I find myself in that camp.
It's funny. He was a guest a couple episodes ago, and he described what you just said. The other question I asked them, and I'm curious your thoughts, is how would you rank these asset classes over the next decade in terms of performance? U.S. stocks, non-U.S. stocks, core bonds, precious metals, and you could even throw tips in there if you like.
I would do precious metals, non-US core stocks, tips, US stocks, and US bonds.
I think that was the exact order that he listed as well, which is kind of interesting.
I've often wondered, we have very similar, he's not a subscriber to my research. I think he should. So if you're listening, Jeffrey, please reach out and get in touch. But yeah, that's exactly the split that I would do. We frequently, Alex, seem to be on the same wavelength.
Sounds like it. Are there any asymmetries that you see in terms of assets? So, for example, gold might have more upside than downside, or US stocks may have more downside than upside. Are there any that stand out to you?
What I would say, as I said, that these typical periods of adjustment, right, these inflection points, when you look at the cheap asset and the expensive asset, let's say US tech stocks, energy, mining, metals, right? You can normalize these differentials in one of two ways. Option number one, the nasty way. US tech stocks get hammered, right? Gold goes down, but not as much, right? Mining and metal stocks go down, but not as much because they're not zoned, okay? But they go down, right? Very little goes up, right? It's nasty. Or you can get the nice way where US tech stocks go sideways for the next decade, right? And all these other things play catch up. It rarely happens. Typically, that initial phase is nasty, right? It is nasty. You find out that when you try and play Jenga, Alex, and you pull money out of US tech stocks to go and buy, mining stocks, that at some point the pyramid, the pile falls over. And so I would urge caution at this point, right? We think the S&P is probably heading towards 5,000. We said that for our retail clients at the very end of last year. We said, take some cash, be cautious, right? Feel comfortable, look to kind of, if we get big sell-offs in some of the assets that we want to own, kind of own those. But we generally think we are in a bear market and we're in this kind of classic kind of topping pattern that comes with a bear market with lots of just chopping. And so, I want to own, gold's had a very good run. It's one of the few. Silver's very cheap. Mining stocks are very cheap relative to gold. I do think the gold story is somewhat idiosyncratic, right? Because I think you have the strong hands of global central banks, and that's what they buy. They don't buy silver. But I do think if and when we start to see the dollar materially weaken, especially if it's driven by the Fed easing rates, Alex, right, and essentially re-liquefying the system, which is in itself reflationary, that's when you go into silver, industrial metals, all mining, all of those things, right? And so I'd be looking to buy those, but I'm afraid I think we're looking to buy those in a risk-off, nasty environment. So that's why I think you need some cash.
Yeah, and I'd say at the very least, a key takeaway from our conversation today is be more diversified than you probably are, because you're very potentially at a major inflection point. And one of the biggest risks that you have is if you're overly concentrated in what happens to be the wrong thing, you could face a lot of downside risk.
Lot of downside risk. I mean, I think, look, Cisco was a great company in 2000. Right? It still arguably is. Microsoft was a great company in 2000. They still lost an inordinate quantity of your money if you didn't manage that risk well.
Julian, this has been great. For our listeners interested in exploring your ideas further, would you quickly tell us about macro capture and how they can potentially access you?
So we launched a retail product at the end of last year. It's designed to help you to kind of educate you in macro, which is not necessarily the easiest thing. I've been doing this a long time. And as I said, I do think there are easier things that I could have decided to do with my life, but educate you, enable you, so in a sense that you can interpret the world. It is also helping you to position you mentally so that you're prepared for these inflection points. So you're looking for the signals. So you're mentally ahead of the market. And then thirdly, it's designed to make you money, right? I am not one of these people who just wants to pontificate and not help you make money. So there are actionable trades in there. And if you're interested at all, please reach out. You can go to our website, mi2partners.com, or just reach out to support@mi2partners.com. And if you don't want to do that and you just want to follow me on Twitter, it's @JulianMI2 or X. Sorry, X. Just showing my age again, Alex.
There you go. Julian, I appreciate you sharing your insights today. Thank you so much.
Pleasure.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.